believe strongly that real estate should be a core component of investor portfolios. And as you can see on this slide, commercial real estate is a large investable asset class. When you talk about the total investable universe, it is in third versus bonds and equities. So commercial real estate represents about 16% of all investable assets in the US, bonds being the largest at 42%, and equities about 36%. So this is, again, a large asset class which we think has tremendous potential to be a real diversifier for investor portfolios. And why? Because we've got investors who are seeking regular and predictable income to meet their daily living expenses. You get that from publicly listed REITs, many of whom pay dividends of 4, 6, 7% per annum on a monthly basis. That revenue stream is very stable and predictable because it's contractual in nature. So the revenue that's earned by or received by a REIT is basically as a result of leases that REIT signs with its tenants, whether that's an apartment, so with individuals, or that's in an industrial oriented REIT where they're signing leases with the Amazons of the world. And again, those are contractual revenue streams which lend itself to greater predictability and stability. As I mentioned, REITs are really excellent portfolio diversifiers, and in many ways are a good means to dampen the volatility in one's portfolio because you're getting 4, 5, 6% yields that are paid to you on a monthly basis. So when the market is a bit more volatile, that volatility is dampened, and you're getting paid to wait out that volatility by virtue of that high dividend. And that's important because the dividend that you would get from more traditional non-REIT equities in the US or Canada would typically be below 3%. So you're getting something substantially higher than that from a REIT. Part of the reason why is that the REIT doesn't pay tax, so it's able to flow through to investors a higher level of income because it doesn't have the tax leakage at the entity level. And we've come across various surveys that have been conducted over the last few months, which shows that about 83% or over 80% of financial advisors are now looking to recommend REITs to their clients. And on a go-forward basis, over 90% are expected to increase their allocation to publicly listed REITs over the foreseeable future. And we really agree with that analysis, as I mentioned, because of these positive attributes that REITs provide or a portfolio of REITs provides. And over and above that, as I'll describe in a few minutes, we think the entry point today is extremely attractive. Why should I be looking to add REITs to my portfolio? Well, one thing we know is that over several years, if not decades, institutional investors have been increasing their allocation to real estate. Again, for the reasons I mentioned, good long-term performance as well as diversification benefits. And more recently, again, institutions are increasing their allocation to real estate because they do provide better liquidity versus private investments. So these publicly listed REITs, if you go through their shareholder listing, not surprisingly, institutions are typically at the top of their shareholder register because of their ability to provide some of these positive attributes in addition to that liquidity versus owning privately listed real estate. And as you've seen in the news over the last several months, whether it's a Blackstone or a Brookfield or other institutional managers of private real estate, they don't provide liquidity to investors when investors are looking for liquidity. And many of them are now gating redemptions. So if I'm an investor in a private REIT pool or fund, and I've put in my redemption, I'm now having to wait several months or even years in some cases before I can get that money back because the manager of that fund or pool cannot readily sell assets or refuses to sell assets to fund those redemptions. And investors knew that going in. So What's interesting here on the right-hand side of this particular slide is that you see REITs versus other asset classes. When you look at return and volatility or risk, what you're looking for are asset classes that have as higher return with the lowest risk as possible. And the NAREIT index, which is basically the index that covers US REITs, is got amongst the highest returns with the lowest risk. So again, looking at this over the last 20 years, the data proves the benefit and diversification benefits you get from owning publicly listed REITs.